Here is a number that should stop you in your tracks. In 2008, a perfectly diversified portfolio, stocks, bonds, real estate, international exposure, still lost somewhere between 30 and 40% of its value. Before we get into why, what you're seeing is an AI-generated avatar. The ideas, the research, the perspective, all real. We just think this is a pretty cool way to bring it to you. I'm John, and today on Beyond the Ticker, we're breaking down what diversification actually is, why it matters, and why understanding its limits is just as important as understanding the concept itself. Diversification is the practice of spreading your investments across different assets so that no single loss can devastate your entire portfolio. The logic is straightforward. If you own stock in one company and that company collapses, you lose everything. But if you own stock in 50 companies across 10 different industries, one collapse becomes a minor setback rather than a catastrophe. That principle is sound. It has protected investors for generations. But it works because of something called correlation, how two investments tend to move relative to each other. When assets are uncorrelated, they move independently. When one falls, another may hold steady or rise. That opposing movement is what makes diversification useful. The more uncorrelated assets you hold, the smoother the overall ride. So why doesn't everyone just diversify broadly and call it a day? Because correlation is not a fixed law. It is a tendency. And tendencies have a habit of breaking down at the exact moment you need them most. Go back to 2008. Investors held diversified portfolios across domestic stocks, international stocks, real estate, bonds, and commodities. Under normal conditions, these assets moved somewhat independently. But when the financial system came under stress, investors across the globe needed cash simultaneously. They sold whatever they could, regardless of asset class. Correlations spiked. Assets that had historically moved independently began falling together. Diversification softened the blow, but it did not prevent it. The same thing happened during the dot-com collapse in the early 2000s and during the initial COVID sell-off in 2020. In moments of systemic stress, the relationships diversification depends on can compress quickly. This is not an argument against diversification. It is an argument for understanding it honestly. Diversification reduces concentration risk, lowers day-to-day volatility, and prevents any single bad decision from becoming permanent. Any serious portfolio needs it as a foundation. But it is designed to manage the risk of individual investments underperforming, not the risk of entire markets moving against you at once. That is a different problem entirely. Every strategy in investing has boundaries. Diversification is no different. The investors who have navigated markets most effectively over time are not the ones who found a single strategy and stopped there. They are the ones who understood what each tool was built for and stayed curious about what else was available. We will be coming back to diversification more than once on this channel, because once you understand what it does well, the natural next question is what fills the gaps it leaves behind. That conversation is worth having, and we are just getting started. Beyond the Ticker exists to be a resource you can trust. Subscribe, like this video, and if someone in your life could use this, send it their way. We are grateful for everyone who has found us. See you next time.